Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
Good morning, or good afternoon, it depends. But anyway, it's weekend time once again. And sure as hell, we are back for another weekly market recap at the end of what you could define as a pretty volatile week, right? I mean, it was a very fun week, maybe a bit scary at times, and sure as hell, it was very busy and, you know, to some degree intense and maybe stressful, especially if you worry metals, right? But, you know, other than that, let's have a look at what happened. Now, I promise the part of the economic calendar will be particularly short this week because we didn't have a lot. Like, we did have ADP employment change, the weekly report, which, well, you know, for me, didn't really tell a lot. I think we are going to have a bit more clarity and the markets will be a bit more focused on what's going to come next week with the JOLTS and the NFP and unemployment rate and all the rest. So this one right here, yeah, I mean, if anything, you could say it's not super strong for now, but, you know, I'm not really reading a lot into it. I mean, I'm glad we have these weekly updates now, but, you know, again, I think we need more sample sizes of these. So, you know, for now, it is what it is. Sure, better to be positive than negative, but, you know, I really can't read a lot into it. It might be my own limitation, I don't know. But anyway, so let's move on with another nothing burger, basically. So the Fed, as vastly anticipated, they left rates untouched. So, you know, for now, this is where we are, a little bit of a pause in the cutting cycle. The press conference was, well, one of the most boring thing I've seen recently. But I mean, again, it was to be expected. I guess it's just, you know, we don't change rates. You know, all the rest of the questions by the press was about what? Political garbage, essentially, right? Lisa Cook, will Powell stay in, you know, on the board even when his term is over? Will he resign? And all the spat with the president, which is currently going on. And again, what do you expect? The majority of the questions were answered by, I can't comment on that, you know? And even when you go into a little bit more of a technical side of things, like, why do you think the dollar is crashing against other currencies recently? I can't talk on that. We don't comment on the dollar because that's a prerogative of the Treasury. Right, so, you know, it's not a job. Sorry. Yeah, okay. So, you know, what did you come here to speak about? The same thing, right? You know, we are monitoring the situation, and we will act accordingly. The balance of risk and all the rest. So, you know, pretty that type of a press conference. But, you know, anyway, again, another thing which was really telegraphed, if you wish. So then what we got, well, I mean, I included this one. Usually we don't look at these metrics right here, right? But this time around, I wanted to highlight this point. Look, and it might be clearer in you know, going on why these might play a role, right? So trade deficit, which is shrinking right now, at least compared to the huge peak there was in 2025. All right. Now, that means basically that the US are importing a little bit less, maybe exporting a bit more. But, you know, on net balance, if the deficit is shrinking, the delta, the difference in between the huge amount of imports that they usually have and the exports that they have as well, it's reducing, right? Now, that means if you think about how the current financial, mostly monetary system is designed, it means that if less goods are getting into the US, well, that also means that less dollars are flowing out of the US, which at the current moment in time, it might be a little bit controversial because you could say, well, but the DXY is going lower, right? If you're talking about some sort of a potential dollar shortage due to these trade dynamics, shouldn't we see the dollar going higher against other currencies? I think the key there, it's in the time, right? Because, a lot of nations all around the globe, they have a lot of debt, same as the US, right? And, not all that debt is denominated in their local currency. So what do? Well, they produce stuff, they export into the US, they get the dollars, and they use those dollars to pay down or to roll over the debt that they got, and it's denominated in dollars. So in order to see some sort of a dollar shortage, you would wait for that debt, dollar-denominated debt, to come due. At that point, if there is not enough dollars flowing out of the US, you should start to see a little bit of a shortage, right? So people need to get the dollars to roll over the debt or to pay it down. What do when they need dollars and they can't acquire them by, global trades? They sell assets or they buy the dollars on the open market, which should see what? Their local currency going down and the DXY conversely going up. Although, usual caveat, most of the DXY, it's just the euro and the yen. But, it's a metric which might be interesting to look at in the future if it keeps on going like this, right? So, I just wanted to throw it out there. Now, what else? BPI, again, for me, it wasn't a huge deal. It's almost never a huge deal. We already discussed what could be interesting in this one, comparing it with the CPI. But, other than that, it looks, stable enough to me. Like, we got some spikes here and there, but overall, you're not seeing a runaway type of inflation in the producers as, you could have been able to see back in 2021, right? So, again, it's not a thing that, for now, it doesn't really give me head scratchers when it comes down to, inflation, renaissance, and all the rest. For now, I'm still of my opinion that you're not going to have another huge inflation problem. Sure, there is all the theme about reflation now, but we discussed that last week, so I'm not going to repeat that. Same behavior we are looking at in the break-evens for now. As you can see, they ticked up this week once again. So, it might be that we will. It's just the market, it's pricing in probably a little bit more of a high inflation into the future. And again, same controversy with what we can observe in true-flation as for the PCE, which is now at 1.45, and CPI, which is at 1.24. So, trying to put all the things together, what you see is this, essentially. Which is why, again, I'm not, for now, at the very least, unless, something drastically changes, but I'm not overly worried over inflation. Because, look, in the past, 2021, you see that true-flation, the true-flation gauge, how do you say that? Well, let's call it metric. I want it to be sophisticated, and I just realized I cannot, because at the end of the day, just play cool with your own language, as they say, right? But anyway, true-flation metrics, they were kind of leading the headline CPI to the upside, right? And everyone was, I still remember the stories, right? Yeah, CPI is at 9%, but it's a lie, it's CP lie, because inflation, the real inflation, is actually even higher than that. So the government is lying to us. Yeah, well, sure. I could agree with that, maybe, right? Maybe, just giving the government the benefit of the doubt, It's not that they are lying, but, at the end of the day, they are trying to apply a standardized type of metric that including a specific basket of goods and services in these metrics. So, it's just sometimes the world moves so fast that you can't adjust the data fast enough, right? But anyway, I would agree with that narrative or that statement, if you wish. But if you agree with that, it is also true that now you see true inflation metrics leading to the downside. And, they picked a little bit ahead of headline CPI, and then they completely mean reverted. They crossed below the headline CPI, if you want to look at it as, a set of moving averages. And look, as the delta was expanding to the downside in this case, they were dragging the headline CPI down. Of course, then, let's call it a little bit of a consolidation running the same parallel. And then, every time you see the delta, which is widening, at a point, it's being closed in by what? By the headline CPI coming back down, catching up to the downside. And you see now that, this white line right here is going lower and lower and lower. So, if recent history is any good teacher, you would expect the headline CPI to keep on following it to the downside. So, that, for me, that already throws a dent into the reflation narrative. But again, we will see. It is, these macro data points, they tend to move very slowly. So we might find out the truth in another 6 months or whatever. But for now, I would say this is what the data would suggest to me, right? Other than that, credit spreads, they're still, particularly low. Although, there are a few people which are starting to worry about, not the credit market in general, but a few niches or a few pockets of the credit market. Like, just if you just read this extract from an article I was reading this week, private credit, it grew like a lot, but there are a little bit of worries over the lack of transparency, and therefore the potential ability to assess systematic risk. So, people are starting to look under the hood. And, again, getting back and quoting Jamie Dimon, you start to see cockroaches coming up. And when there's one, there is usually more. So, again, it's another situation that you have to monitor at the end of the day, right? What else? Well, nothing else really for the economic calendar or for the usual data points. So let's jump into the charts, right? Starting out with the DXY, all right? So if you remember, right, last week we were talking about the market closing a very bearish note right in here. And we were discussing the ability of this region to hold up once again, now that we basically, we used it as a launchpad for the upswing, then kind of retested it, a little bit of a front run in here. And then, there was a bounce which was faded. So the question was, how much do you think it can absorb now? Well, apparently nothing, because we immediately gapped down on Monday and slashed through it. And we kept on drifting lower, particularly violently, on a Tuesday, up until the point we kind of found a little bit of support. I mean, we tried at least to get a bit more stable in here, and eventually the market just bounced back up. Now, before getting into what the potential reason might be, although again, it's not, I don't think it's really all there is, but, that's what the majority of people, at least that I know, are trying to come up with, trying to rationalize these moves. I always find that process fascinating. Like, why did that happen? Well, because, 48 hours later, someone come up with a solution to the enigma or to the riddle. But quite honestly, if you look at the charts, more often than not, I'm not saying there aren't some specific events out there in the real world, which could impact financial markets and therefore price action. But I would also say more often than not, what you're looking for is already in the chart, right? So we are testing back into what was expected support, although, as we said, not that expected at this point. So what you need to observe now is, what do we do here? Do we reject this area kind of like this and we keep on rolling over and therefore the DXY keep on plunging? Or, same story again when we talk about pivoting areas or levels in a chart, right? Or can we reclaim it, right? And therefore, if we reclaim it, we might get back into the same range we have been. So basically this one and this one over the last few weeks, I guess. Yeah, since the beginning, at the end of December, sorry. So I guess that's what would catch your eyes next week. Getting back to that reason that people are trying to stick to it in order to explain what happened, Trump just announced the nominee for the next Fed chair. And of course, it's not Kevin Hassett. I think, again, I don't want to be political, but I think it was too hard to push it through, right? Even for this administration, I think. Because at that point, I mean, it's really like, okay, so Hassett is a pound in the pocket of President Trump. And now, the administration would, control the Fed via proxy, which would be Hassett. And, it was too much, in my view. So, I think they went with Kevin Warsh. And again, this could be the reason, right? It's not a policy dove. He's a little bit more of a critic when it comes down to QE and the utilization of QE every single time. So it could be something that at the end of the day, it gets credibility back to the Fed. It kind of cool off all the worries in the bond market about, the Fed going crazy, money printer going brrr, or the fiscal irresponsibility, or, usual actors, bad actors being continuously bailed out at the expenses of the taxpayers. So the rationale is, since he's a little bit more of a logical person, right? He's not that type of a wild card when it comes down to the unlimited usage of these monetary tools and interventions. If we nominate someone like him, we might send a message to the market. Look, we might be a little bit eccentric, but we are not completely knuckleheads. So we don't want to completely ruin our own currency or our monetary system or our fiscal situation and all the rest. Is this really how it's going to play out? I don't think so. In the sense that, I would say he might have played a bit more hawkish than what you would expect just to get the nominee. But we know too well that if shit would hit the fan, he would do the same that all the others before him just did. So, QE, bailing out banks, you name it. Because at the end of the day, it's kind of like when we were discussing the yen in Japan, right? At the end of the day, the establishment will always try to save the establishment and the status quo at the expenses of the normal citizens, right? That being said, do I expect the DXY to completely plunge just because of that? In the short term, maybe we could see a bit more of a further weakness, but, I do also believe that mean reversion, it's like the biggest force in markets. So, after this kind of a fail breakdown right here, right? There were these two swings in here. We just bridged them briefly and immediately got back into this level right here, right? So could it be that at the end of the day, it's going to be a failed breakout? Maybe. My assessment for now would be kind of a wait and see mode. When you get these spikes in volatility, I'm always on the watch out. I'm just going to judge the reaction here, right? So, I'm not completely discarding the fact that we might chop around a bit in here, maybe a few days, and then we finally see what the DXY is going to do, right? But for now, I know that technically you might say, how can you be neutral? You should be bearish as fuck. Yeah, well, technically, yeah, you're right. It just broke support. We are retesting it. It might be a bearish retest, and you're going to see continuation. But it's a bit more of a hunch, right? So again, nothing really technical on my end this time around. But I also do think that, I'm not expecting an immediate plunge, right? So at least a little bit of a consolidation in here, and then we will see, right? So that would be me, neutral for the next week, or the next 2-3 trading sessions, and then we will see what's going to happen. Obviously, the rest came back down, like you see. The euro hit 120.5, and it was immediately rejected. But to be fair, it was particularly extended, right? So, again, mean reversion. The farther it goes, the weaker it gets. All the usual cliches, right? And we have seen basically the same across the board. Like even, all those currencies which have had a very good run, they pulled back. Does it change the trend? Well, the current structure, no, but same. I'm not expecting an immediate bounce from here, right? Let's say I'm taking the euro as a proxy. Like, we might get it, but I would say before that, I would favor something like this. So maybe we come back down a bit more, then we try to rally, we come back down a little bit, we try to build up a new base in here, and then maybe finally, again, could be a few days, could be a few weeks, I don't know, but that's what I would expect. And finally, we try and again higher if the current trend remains intact. It's just that when I see these huge spikes in vol in assets like currencies, which are not set up to move a lot like that, I do also believe you need that period of a cool off, right? Before the next move. So first and foremost, I would expect a little bit of choppiness, maybe a bit more of a test down lower, both for the euro and the pound. And, dollar Canadian. Well, first of all, dollar Canadian obviously took that high, as you can see, and it went past beyond it. We basically traded above all these recent highs in here. And well, we got back into this pocket from back in the days, September 2024. And we found a little bit of an initial resistance there. But again, we pulled back. So what's going to happen? Do we bounce in here? We test a bit deeper to the downside before, again, same concept, seeing if we can reaccumulate and push again higher. So I think there is still overall across the board, even in the Swissy, a little bit of a more room to come back down, to retrace a bit more, and then maybe going a little bit sideways before the next move, right? As for the rest, well, I mean, Friday was a huge down day for the South African rand, although, the trend is absolutely intact in here. Chinese yuan, same. I mean, tiny bit of a down day, but still going up at a very sustained pace. The Brazilian real, same pattern as all the rest, right? So nothing new, no need to repeat. Indian rupee, again, no need to repeat. It stays relatively weak compared to basically everything else, right? The Australian dollar, it ran like a lot. So again, same discussion. I would expect at least a little bit of a consolidation, if not a bit more of a pullback to fill in this inefficient run to the upside. Overall, in the grand scheme of things, where is the Australian dollar? Well, I mean, that high was particularly relevant, right? Again, October 2024. Fundamentally, I would say about the Australian dollar, I mean, I don't know if you ever heard that, but it is called or defined a commodity currency. because, a lot of commodities are produced, mined in Australia, and then they are exported. So in order to acquire those commodities, what you need? Well, you need the Australian dollars that they ask you in return. So, when commodities perform particularly good, the Australian dollar tend to follow because there is a lot of demand for those commodities, and you need to get what in order to acquire the commodities? The Australian dollar first. Sure, again, it doesn't go for all commodities, absolutely, but, there are a few, and there must be a reason if the currency gained that type of a nickname, all right? So, might be tied with what we've seen in precious metals, maybe. But I just think at the end of the day, it followed what the rest of the market was doing anyway, right? Russian ruble, same. It kept on going higher. It's putting in maybe a little bit of a consolidation in here after taking this high. And now we get a little bit of a preliminary support in here, I would say. And then another one could be this pocket right here. So, basically from the top of this shelf down to the bottom. I'm going to highlight the bottom only because, I don't want to flow the chart with a lot of horizontals. But anyway, you get the gist of it. Now let's have a look, speaking of commodities, at crude oil, which it extended the bounce to the upside. So basically this week, except for Monday, which was a tiny little bit of an inside, but no, it's not inside. You got this spike right in here, but let's call it consolidation, price pause. I'm sure, if you zoom in, do we get some sort of a breakout tag in here while it was, could be this one, right? So we come back down, rounded reaccumulation on the hourly time frame below the weekly open, break above it, a little bit of a tag of this consolidation before actually shooting higher. So it might be something like that. But, anyway, other than that, the rest of the week was all to the upside. And we managed to get back into this level, which it's not, it's not a level per se. I kept that in that position just to keep on highlighting this swing failure right here before the run down. And, whether you believe it or not, we found initial resistance right there. So, is it a line in the sand? Is it a hard level? It was basically just an area, as you can see. It was this area right in here. So, sometimes it's not just a specific price level. It could just be an area, like in this case. We got this move down on Friday, and then immediately it was reabsorbed, and it ran back higher. Let me zoom in a little bit just to see the anatomy of this move. Well, it looks like the majority of the move happened overnight in Asia, and then it was going up throughout the European session. Kind of like mid-session in the US, there was this sudden drop, and then immediately bounced back up. Don't know what to make of it. It looks like a range at the end of the day, but we are still trading toward the high side of the range at this point. So, it's hard to be bearish on crude oil now. And again, we know that the situation in the Middle East is not completely sorted out. And actually, I think, if you read the headlines or the newspapers or you listen to the news, it looks like it is escalating by the hour, right? With, President Trump threatening an intervention, military intervention, with the usual tone, right? We got very powerful ships. The Navy is already there. Our military is unstoppable. And look, we do hope we are not going to use it, but we need to make a deal, right? Same type of logic. You know a deal? You know what a deal is? I love when he goes like, you know what XYZ is? Like, well, it is so obvious, right? But, so it could be something like a little bit of a geopolitical premium right now. And, don't discard the fact that if and when, I think at this point, it's more a matter of when rather than if, but, you can't know for sure. But anyway, when you might get the strike, the military operation or whatever that spark, I think there is the potential for oil to spike even higher than these, right? Then we will see. It might be something like what we've seen when they bombed the nuclear sites with the bunker buster bombs and the B2 spirits. It was quick, and then it was, immediately faded because there wasn't further escalation, and it wasn't an open war. But I guess you need to pay attention to that. In case we have a pullback in oil, which at this point, again, considering these tensions not de-escalating, but if ever we might have a pullback, these area right here, right now, it's prone to a rebalance. So maybe I'd say it could pull back like in this area right in here. If you want to see the market carving out support, I would look at the top of this range right in here, right? So basically this. Why is that? Well, because if we bounce in here, right, and you remember when we zoom in with that breakout tag, the reaccumulation below the weekly open, that would fit a bullish narrative in my view. But, on the way up, we basically consumed a lot of liquidity. You see all these spikes to the downside. It just means that every single time before running up, we came back down lower to pick up additional liquidity. So, on one hand, that is true. It means that the move up, it's structured, it's ordered, and all the rest is organic. It's not impulsive, aka it's not inefficient. But at the same time, it also means that we already depleted a lot of inventories below here. So if you see the market cracking this level, I don't think it's going to be like a tiny little crack. I think the spike might be violent, right? It doesn't mean that we are going to completely crash. Also because you could say we got another support down below, but, could bounce off of it later on. But again, I think if I wanted to play along in here, it would be along in here with a very tight stop. Maybe, I would use these point of release right in here as protection for my entry. But, as soon as it starts to crack, I would get out because I would expect a bit more of a spike to the downside. Then again, it doesn't mean that you can't try again lower, but it's just, one of those setups where I would like to see it working rather, sooner rather than later, right? Now, let's start to talk about something painful. So let's start out with Bitcoin, which, well, what can I tell? At the end of the day, again, it wasn't looking healthy, to start out. And it was a pretty decent and a very easy assessment, right? We started to fail in maintaining the current upper structure or upward structure, and we immediately failed, losing this level, then losing this one. And last weekend, I guess we were in here, if I'm not mistaken. Yeah, 24th of January was a Saturday, was in here. Yeah. So we already had a retest in here, and, it was a failure. And again, what did we say? Look, as soon as we start out to take out this low, and then, there is a lot of sparse liquidity to be taken in here, watch out, because we might be due for a test farther down toward this low. Now, I don't know at the end of the day if we're going to, take out this low and trade below it. I don't know yet. We will see. Sure as hell, it doesn't look healthy, but, there is always hope up until the point it doesn't happen, right? And so, we took out these low, preliminary low, basically on what? on Sunday, so right after finishing the recording, and we traded. Let me check now. I got too many drawings here, and we traded where? Well, yeah, right below those spots lows in there. We found a little bit of support in here, which again is always nice. It's nice to see it working, right? And we rallied back up, but again, we were, smashed at the same exact level of before. Then at this point, we really accelerated down to the downside. Look, I don't know what happened on Thursday because it's not to brag or anything else, but I'm not eager to always scrap the internet to find the potential reason for this sudden drop. To me, I had a little bit of a bias, a little bit of a plan, and a broad idea about how things could have shaped out a week ahead of times. So that's why you might like technical analysis more, because then you don't know to look for motivations or rationales, but why, to explain why this crash happened. I mean, then again, crash, Bitcoin, it was down what? 5% for the day. For Bitcoin, it's not huge. As for a single day, then if you look at the entire context, all right, I get it, right? But it is just what it was supposed to be. Up until it was below this level, risk was to the downside. As soon as we take out the low in here, the lows in here, even more risk to the downside. Guess what you got coming? Right, that downside move. Now, it is Saturday morning now. The market, again, looks a bit weak. I mean, we are not seeing a lot of reaction. Especially, after this type of a, what do you call it? A hammer in here. Maybe, if you were looking at, let's say, the futures, and they close like these, then you might say, okay, we got that. So maybe there is a little bit of a hope for a pullback, right, into this weak leg. And then we'll see what's going to happen. But, so far, it looks like we are not getting even that. So, everything could change, like this afternoon or Sunday, but it is weak, has always been the weaker if you compare, Bitcoin against, let's say, the equity market, right? And again, I was joking this week. I don't remember if it was yesterday, but, to me, Bitcoin, it's leading, right? Both ways, in the sense that when there is a massive speculative rush, a massive risk-taking type of dynamic, Bitcoin is running a lot because, it's less liquid than the rest, and it's easy for people to pile in, right? But, the problem is that it works in reverse too, so that, when it drops, or when, there is a little bit more of a risk aversion, what do? And again, I use this type of a joke to describe it, but let's say you are a hedge fund and you see, broad markets being down. If your risk manager comes in and tells you that, and he proposes you a few alternatives that you could, liquidate, trim down, what do you sell first if you have to the risk? Well, not only the thing which is outperforming, obviously, but maybe the thing which is a bit more volatile, which could expose you at, further more incremental downside risk. So this is why I think when you go in these periods where markets are a bit nervous and uncertain, you don't see a lot of strength in huge risk on assets like Bitcoin. Now, before we end up the video, I might get back to it to see if you're still above Friday's lows or not, right? But anyway, for now, let's move on and let's start to check the metals, because even there is a lot to be told this week, right? So to lay down the context for metals, let's have a look at two tweets that I was looking at this week. Throughout the week, it wasn't necessarily, obviously, it was before what we've seen on Thursday and Friday. But, and I'm not saying these are not truth, right? These might be absolute truth. It's just, I'm going to give you the logic there. So, you see, for example, silver inventories at COMEX are completely depleted, and there's not a lot of silver laying around. So if people keep on buying silver at a point, there is not a lot of physical silver available. So they will need to what? Pay higher prices to get it, yada, yada, yada. So, basically it was a massive bullish pitch, right? Which, again, I'm not arguing against it. I think that this is a dynamic which is 100% true, right? If we keep on buying silver and there is not a lot of physical silver lying around, price will go up. It's just supply and demand. Okay, but, I got this one. Then you got this other one. So, usual story about how gold overtaken treasuries in central bank FX reserves, which, again, it's a thematic. It's something that we already discussed. I'm not discarding it. I'm not discarding the fact that, major central banks all around the globe are maybe diversifying or changing, modifying the composition of their reserves, mainly, in my view, for geopolitical reasons. It doesn't have anything to do with the monetary system or the dollar being doomed next week, but it is a fact that people are starting to diversify, right? Obviously. Now, I always have this kind of a bug in me, which, show me the quantity instead of the dollar equivalent, because obviously that could be faked by price movements. All right. But again, these narratives always going around. And then there was another one, which was basically, I think, last Sunday. Yeah, it was posted in one of the Discord channel, which was this one right here. Again, I'm not saying it's not going to be true, right? But, the White House is currently considering a strategic silver reserve, which left me a little bit skeptical because, well, and again, bear in mind, I'm joking. It doesn't have anything to do with the long-term implications for gold, silver, or Bitcoin. But I was like, that's nothing new. Must be me, but I think I remember a similar statement. It was about what? But it was about Bitcoin and what happened next, right? So again, obviously it didn't happen right away, the day after, but when you see people starting to push so hard on such bullish narratives, I'm always like, a little bit on the fence for that. And then what you get, of course, is this with gold, right? Which, we are looking at the future, so spot price might be a bit different. And I know for a fact because, I usually play around with GLD, so I know prices might be different, but movements or the trend is always the same, right? So what we got is from peak to trough, 16.5% pullback, which again, let's be clear. Does it invalidate the long-term trend for gold? Well, no. We barely got back into support, if you want to look at it, right? If you look at a daily time frame, right? So, at the end of the day, it was a major scare. It didn't destroy the upward trend, right? If you zoom out, you can clearly see it. But nonetheless, it speaks a lot to what I was saying, started to say like 1 month ago. And again, usual caveat, if you're in for the long term, if you're holding physical or an ATF or whatever, and you plan on keeping it and looking at that in 5-10 years, that's all cool. But again, if you're playing with it, using margin, using futures, using options, maybe, just be careful, because when a market goes like this, it's very prone to sudden pullbacks. Again, even in the past, we've seen what was going on. Now, a drop like this, it's not something you see every single day in gold, let alone the others. But, it's it would be disingenuous to say, oh, well, this is topping out, or this is the end, sell all your gold right away. But maybe not. I mean, or at least maybe not yet, because again, the market is still basically going up. So, in order to say, well, on the daily time frame, this trend is over. Let's say we cracked this support right in here. We broke this major trend line, and then we got back up, retested it, and plunged once again. So the party is over, even for the long-term gold backs. Well, we're not there yet, right? So, just again, you needed to pay attention to the upside for what could be a very sudden deleveraging event. But at the same time, if you're in for the long term, don't be shaken out by sudden drops like these. Now, it's interesting, let's try to zoom in. And I'm gonna try to describe, because as I always say, I'm involved with gold. So, what was difficult this week, I guess, it was that we started out the week, basically we were in here, right? So Monday, okay, weekly opening up to the upside, all right? And then, I'm going to tell you a little bit of my story and how I tried, successfully or not, that's up for debate, but, it could have been worse, right? So we opened up the week to the upside, and we hit, the future got up to 5,100, more or less. And at that point, I was already kind of like, okay, so wait, we gapped up, no fill yet, we hit, a good round figure. You know what? It's been a good run, right? Because if you think about it, that was happening on January the 26th. And, well, yeah, it was the 26th. Yeah. I mean, just 10 days earlier, we were at 4,600, right? So, again, we jumped up, what, 10%? So, bottom story is I sold a little bit of my holdings. Not a lot. It was like maybe 8%, something like that. Just because of that, right? Just because it was going up. It was, I think, the fifth or sixth day, which was going now up and up and up straight away. So I said, well, you know what? Just for the sake of it, let me sell a bit of what I got, just to trim it down and put a little bit of profits in the pockets, right? Then what happened was, we came back down, we filled the gap, we reacted very well, immediate bounce, and we kept on drifting higher on Tuesday. And then, we just expanded to the upside on Wednesday, and we kept on going up and up and up into basically Thursday. Now, at that point, I think Thursday was what? At this point, right, somewhere in here, right, before the European Open, as you can see, so basically these line red and black, that you can't even see that now, but if I zoom in, and you can see that, right? So basically the European Open, so Frankfurt Open, London Open, I was like, so, okay, we got even higher than where it was, and I was thinking, but look, 3 days ago, it was a what? 5,100? We are now a what? 5,600? You know what? Especially looking at this leg to the upside, let me sell a bit more. And I sold another 8%, kind of like. So, if it keeps on going higher, well, so be it. With the remaining, but it would be irresponsible for me to not take profits when the market really runs like that, right? Lo and behold, what happened the very same day in the US session? Massive down leg. That was huge already. But even in there, I was like, I was seeing at the end of the day, we basically attempted a bounce, And I was like, well, you know what? If you check, at least if you check the recent times, every single time, can you see this blue box right in here? You know, that's basically the Asian session. So I was like, well, you know, if the Asian session is going to be to the upside once again, as we've seen in the past, in here, or in here, or in here, and then I don't have any other boxes. But basically, before the European Open, you can see this is Asia, right? And again, before the European Open, you can see this is Asia, right? So, you know, usually there is this theme going around that a lot of buying activity goes around throughout Asia. And again, we have been discussing why China is holding a lot of gold now or increasing the holdings. Well, to diversify and not being exposed to the US, retaliations eventually, like the Russian did. And, you know, because they need to do what? Well, to defend the yuan, because, you know, just in case we get to a point where I need to defend the yuan, what could I do? Oh, I sell my gold, I acquire the dollar that I need, I go in the open market, I sell the dollars, I buy back the yuan, I can, you know, sustain the price of the yuan. So when I didn't see the Asian session going up, but actually fading the bounce, at that point, I was like, well, look, something changed, right? And, you know, technically we had this massive breakdown. We retraced a bit of that and we kept on drifting lower. I think at this point, it's time to really manage risk. Now, I waited a little bit because, you know, if you check the 4 hour, right? So you got this shelf top right in here, a little bit of a shelf middle, a little bit of another support in there. I don't think if you can see on the hourly time frame. Well, yeah, this is it. Should be this one, right? You might adjust it on the hourly. It could be something like this. All right, okay. So I want to see if we can hold this area. Let's say, we bounced, bounce is faded. We come back down. If we can hold it, all right. Then we got this, which was in the morning, essentially for me, around 8, 9 a.m., right? And what was it? 8, 9 a.m., I guess. Yeah, it was basically the European Open, as you can see. Look, we just wicked through this area, not finding any relevant support, both at the shelf top, the shelf mid, and we also crashed through the bottom of it. And, you know, that's where you zoom in and you see that basically it goes like this, right? You see the same lines on the 4 hour. These are on the hourly time frame now. So huge drop, completely obliterating these that was expected support. And at that point, I was like, okay, so let me look at the bounce. If again the bounce is faded, I will need to the risk once again. So we draw back, we filled in immediately. We just fell back down, and it was at this point, you know, again another fade rally attempt. And when this candle closed right in here, I was like, look, I don't know what's going to happen from here on out, but I think at this point I'm going to sell even more because, if you throw out in here the monthly VWAP, I mean, look at that. We have been leaving below the weekly VWAP for now, 1, 2, 3, so 12 hours, and we got the monthly VWAP right below. So, when you see the market cracking this area, bouncing and fading it, again, at this point, I'm really expecting we are going to test and reach for the monthly VWAP. So that's where I immediately sell a lot more. I mean, at the end of the day, I still have a bit, slightly more than half of my original allocation to gold. Now you might say, but you just said, don't you worry. Yeah, sure. That's what I said. And I do believe it, right? The point is that I manage it particularly tightly. And for me, it's not really a problem to sell half of it. And then, let's let's get back on the 4 hour. And then, if I see it kind of like carving out support in here, trying to go higher again, retesting down, confirming a higher low, and then keep on going higher, at that point, fine. I mean, I just reallocate what I took out, and I keep on riding the trend if the trend stays the trend, right? Because the thing is that could you eventually miss out on a few gains if you do like this? In the sense that, well, maybe you're not fast enough, or the market doesn't give you a perfect re-entry as you would wish it. Yeah, right. I'll just blindly buy it. I mean, we're talking sport. There is no leverage involved. So, I'm willing to take that chance, especially after a run-up like this. There is no way, at the end of the day, no matter what happens, I'm going to be down money at this point. Could I spoil a lot of good profits, all in all? Yeah. But you could always say that. That goes for anything, right? So, but that's how I'm going to play it, because, what counts more for me, right? It's not to make sure that I'm going to ride this entire bull market from, day one to day, infinity, or whatever day it's going to end. My worry is that I don't get caught in something like this, basically. All right? Because, again, I think that if I can manage the downside risk, the upside, at the end of the day, will take care of itself. Now, do I agree with the fact that, well, if you just bought and held, you would have made a lot more in percentage terms? Yeah, sure. That is absolutely true. All right. It is also true that people saying that are not usually the people which are selling the top. So, let's take this brief segment of price action in here, right? Now, you might say, well, I bought somewhere in this region, right in here, right? Okay. And then the market was just going up and up and up. So I held. Why are you, let's say, as I did, why are you de-risking in here and then buying back into here or into here or into here? And then you are de-risking once again in here, and then in here massively, right? I mean, the point is that if you stay, right, and you never sell diamond hands and all the rest, at the end of the day, and one day it's going to come, if you get that, doom candle, weekly candle, monthly candle like this, well, how much of your gains are you giving back to the market, right? While instead, it might be that at the end of the day, I'm not going to profit to the same extent the market it's returning, but every single time I'm de-risking, buying back lower, taking profits, buying back lower, taking profits, buying back lower. So you trim down the positions where the market is going up massively, and then you add back in what you trimmed when the market has these sudden and sharp pullbacks. That's how you should run a long-term position, in my view. Again, it is just completely personal opinion. And this is how a lot of money managers are running portfolios. Do you think there is one money manager out there which bought Nvidia, let's say 5 years ago, and never sold a bit, never rebalanced, right? So this is what you do. When you are dealing with money that you really care for and that you really want to see grow, I think that the wet dream, like myself included, like we had when we started into Bitcoin, it is just that, right? And again, you might tell me, yeah, well, I bought and never sold, so the market is going up and up and up. But nobody which is telling that story always reveal, or ever, where and when were they taken out. Because sure as hell, it wasn't the top. So you might say, well, Gold went up from the breakout 60%. Well, 60% if you sold the absolute top. And again, going by that thesis, if you need to see the trend being reversed, well, you would sell what? In here, when we break the first available swing low on a daily time frame? And at that point, you're not making 60%. You're panicking out and puking it for 21, 22%. Which again, that's why I try to be as nimble as I can. Successfully? Well, at times. We are all humans. We all make mistakes. Management is not always perfect. You can't be perfect in markets. But, you know, I hope it makes sense for people why I'm doing it this way. I think it's particularly logical, but people might be free to disagree, right? Like I got people telling me, even in real life, why are you selling? This market is never going to stop. Maybe. I don't know. But what if it does? At least, I'm not going to be able to say I sold the top, right? And I'm not saying this is it, right? But let's say this is it, just for the sake of playing hypothesis, right? Let's say if this is the top, right, and you see the market for the next 1 year, 2 year, whatever, keep on drifting down. And again, I drew these squiggly lines 10 times at this point to prove this point. But, let's say this is how it ends. And again, I'm not saying this is it. I actually think we didn't break any type of structural long-term trend. But let's say this is it. Well, at least, I sold in here. I sold very near the top. And I sold in here, right? So again, did I sold the top? No, but I sold 40% of my exposure very near the top. And then I will keep on trimming and trimming and trimming. And there is a portion of that gold which I'm probably never going to sell. Like, I don't know, it might be 15, 20% of the original allocation, which I'm always going to keep. Also because that part, it's physical gold. So, it's a bit hard to sell it. It's not like pressing a button on a mouse, but, there are a lot of things involved. It's one of those things that you keep it for the rest of your life. You never know. Who cares? I'm not planning on making money on it. It's just some sort of an insurance policy for whatever may happen in the future. I'm not talking about financial Armageddon. But let's say, I'm a day trader. So let's say I go broke, I go bust, and I don't have money to make ends meet. Well, there are those, at this point, they might be, 100, 150K worth of physical gold there. If you really don't know how to keep a roof over your head or food on the table, you can still sell that, right? So, it's just an insurance policy. Or let's say there is a tornado or an hurricane and my house is completely blown out. At least you got something, right? So that's why I'm probably not going to sell that part of my allocation, right? Now, that being said, again, more than enough of my story with gold, but you be the judge of it, I guess. What about the others? So let's have a look. Silver, again, your casual war. Friday alone was from the open to the lowest point, 36%. I closed down only 26%, but again, wild ride for sure. The rest wasn't that different. You look at platinum, you look at palladium. Strangely enough, copper, it's holding up relatively better compared to the rest. And, I kind of hinted at that before, but these lines, these moving averages that you see, the black one is the weekly VWAP, the red one is the monthly VWAP, right? So, why do I keep them on the chart? Usually they are just hidden. So because, they kind of bother me a little bit when I look at the charts and I want to see at the price action for what it is. I just keep them. So, every single time I can just quickly put it on and judging how much deviated we are from the long-term, monthly VWAP. So the long-term volume weighted average price. Or, in other words, you could define it as where is the bulk of the volumes and where, if and when it happens, the market could mean revert to it, right? So, I keep it so that, it works pretty good. You see that every time there is a huge divergence in between these two lines and price, deviate a lot from them, sooner or later it gets back to them, right? So anyway, in this recent event. So this is why I like to, it's another form of assessment. Like, are we really far away from that, call it mean, right? Yeah, well, so maybe, again, with gold, maybe for no reason, casual reason, or it might sell a little bit just because we are massively deviated. And again, mean reversion, the most powerful force in financial markets, right? Now, just a tiny thing on silver, because, the rest, it's pretty self-explanatory at this point. But you remember, we were looking at this leg, right here, and we were saying, well, yeah, it was inefficient, but then we build up, these, and then we built up these while going up. So, you might say this is inefficient and it's prone to a rebalance, but, up until the point you don't see the market at least starting to break this one right here, and that this one, there is no chance for this one to be rebalanced. It looks like the market likes to do it in a very quick and fast fashion. So we, initially, we found a little bit, let's try to zoom in. We found a little bit of a support. There was a bounce at this upper shelf on the 4 hour, right? And, the rest was pretty much smashed. Back to, we rebalanced these inefficient leg we were looking at, right? But beside the initial reaction that you can see in here, at expected, first available expected support, bounce, all the rest was completely traded through. And, again, silver, for some reason, and again, I know that silver bugs are going to hate me now. For some reason, I don't necessarily think that I would put the same odds on silver to quickly recover as much as I would put them on gold. I think silver was way more over leveraged. So, plus, I think historically, and I don't have a chart of it now, but let me see. Maybe I can retrieve it because I've posted it to a friend just the other day. I might be able to have it back. Just 1 minute. But I'm in the meantime, while I'm trying to bring it up, I'm going to explain the reasoning. So essentially, it's just if you imagine the gold to silver ratio, right? What you get, it's basically this. All right, now we have it. I had to download it. So this is the ratio on the upper quadrant. So you see that every single time it was so low, or it spiked so low, and then it mean reverted back up, that was a good sign of a potential top in silver. Now again, you say every single time, it's just 2 times, right? Yeah, on this time frame, on a monthly scale, yeah, the occurrences where you see huge spikes to the downside in this one were basically just a few. You could include this one right in here, and then silver, again, went for a good top. It might not seem like a lot, but remember, these are monthly candles. So it took a lot to silver to, pull back and then reaccumulating it, getting back up. oh, well, we got the date, right? So 2021, let's call it, pulled back in 2022, and it took it up until 2025 to break out and keep on going higher. So I was looking at this ratio and I was like, well, you know what? If that's the case, only a few things might happen, right? That, you know, if you have a mean reversion in the ratio right here, either both gold and silver go up, but gold massively outperform. Gold keep on going higher in whatever fashion you could imagine, but silver will stay relatively flat. Or they both go down, but silver goes down way more than gold. So 2 out of 3, it's not very good for silver in the case this dynamic plays out as it did in the past. Again, does it mean that you should, again, liquidate all your silver and run for the hill? No, I don't necessarily think so, right? If we want to just look at the silver chart, we got back into support on a daily time frame. Preliminary was here. There was another one in here, which was tagged. So I guess at this point, you might start to be worried if you see the market bouncing, right? So filling in this move down and then struggling at this level and starting to roll back, and the bounce, it's faded. We get back in here once again. Let's say we get back in here, right? We might get another bounce from the same region and then again faded once again. At that point, you know, if we start to break this current structure right here, that's where I would be worried for silver to get back into the 55s, more or less, right? So, you know, it's not happening for now, but you know, just wait for it. Well, I mean, again, same goes for if we take out these lows without not even a bounce, right? So let's say there is no bounce, we just immediately keep on drifting and we take out these lows, right? And we can't reclaim them. Same logic. Which, again, looking at the historical price pattern, you know, silver, if, and again, big if, but if it really it's putting in the top, it is usually a blow off, right? So, you know, just keep an eye out for it, and we will see next week when we come back what's going to be, right? So as for the rest, yields, yeah, well, a little bit of a steepener, I guess, because we have seen the long end coming up a tiny bit. The 10-year was basically flat for the week. But the short end came down, oh, I mean, do you want to call it violently? But, well, I mean, it came down substantially more than the rest. So, again, what's that? It's a steepener. With the long end, you know, staying relatively higher compared to the short end, which is coming down. So if you think about the curve, it is steepening out, right? I think, again, not a lot to be said when it comes down to yields and treasuries. A lot of that, I think we already explained that. It might be that, you know, Kevin Warsh is seen as a little bit of a no-kish character in the industry or, you know, in the environment or whatever. And therefore, you know, short-term yields are, again, you know, getting back to an equilibrium point, just because they do expect, to some degree, right, that he's not going to hike rates, first and foremost. And probably they're signaling that if we have a person which is, you know, kind of like responsible, we are not gonna need to ask a massive premium over those treasuries, right? It's kind of like a little bit of a relief sign for markets, the way I'm reading it at the current moment in time. If you want to try to understand it a bit better, let's just think about it the other way. let's say we got someone coming in saying, you know what, well, how much are we doing right now in QE or reserve management, whatever the fuck? It's another name for QE, all right? 40 billions? No. Let's just ramp it out to 1 trillion per month. At that point, I guess, plus, you know what? Let's cut rates 50 basis points. Right? I mean, the first thing I'm gonna do, I'm gonna cut rates 50 basis points. I think that's where you would see yields kind of spiking, right? If you do believe in the narrative that they are, there are bonds vigilantes out there which are punishing the government for the fiscal irresponsibility and whatnot. So, I guess on the other hand, having someone which is perceived as a bit more, of an hawk, and therefore a little bit more of a critic regarding the current, not the last decade, a little bit more than that, policies and interventions which were adopted by the Fed, that could get some relief into the treasury market, right? That's the only thing I would read into it. I don't think there is a lot more that rather than that. So I think that's all I have to say. Really nothing else. So let's move into the stock market and then we wrap up the week. Now, as for the stock market, I think we had a little bit of a two-tape market. Now, again, last week we were kind of neutral, but overall, nothing is broken. At the end of the day, the market could very easily keep on pushing higher, and I remember saying, might be this the time where NQ gets back into the leading seat. Sure, it looks like at the end of the day, we got both of the two type of scenarios, because we started out the week on Monday, as you can see, rallying hard, right, into Monday, Tuesday, and Wednesday. And then, Thursday, we had a little bit of a reversal, right? Now, sure, that there was the usual, going around throughout the Powell press conference in here. But, overall, we started to drop on Thursday, right? Now people say it's because of Microsoft earnings and all the rest. Look, I don't know if everything is tied to Microsoft earnings alone, because, at the end of the day, the rest of the market, like, Meta had earnings. So, two earnings, very different results. Although, even Meta, I think, it gapped up, but then it spent the rest of the session coming back down, filling the gap. So, I mean, yeah, I don't think it's all about earnings. There might be something more to it. And, again, we will explore another quote-unquote conspiracy theory in a minute. But nonetheless, whatever it was, which, I'm not saying earnings didn't play a role in it, but, the market came back down and basically straight down into the weekly open. And if you look at the S&P and the Nasdaq, they closed right around there. Well, actually, ES futures a bit higher than these, but nonetheless, swing high, back to base completely. Which, by the way, beautiful behavior. But anyway, the Dow was even weaker than that, because if you look at the weekly open, the Dow had a run up, but then didn't even took out the recent highs. And it was faded, so maybe the Dow a bit weaker. All in all, as you can see, just checking futures, you see the same. It's still a two-tape market. It's not really going anywhere. There is not a lot of dynamic expansion one way or the other. Every single time, like, I'm going to use, let's use the Nasdaq for this one, just because it's much more evident. But every time we try to expand one direction, like in this case, right, we immediately mean revert to the other. Then what? You got the structural high right here. We try to expand to the upside now. Well, no, mean reverting back into, the middle of the range. So again, this market, it's not really going anywhere for now. You might call it uncertainty. You might call it, and I've seen people already saying, well, again, we are back to the AI bubble, which is bursting. I don't know. Maybe it could be. I mean, at a point, it might, but I don't think we are there yet, especially because, earnings are still good enough. CapEx, it's still expanded. Now, remember that now that we finish with the earnings season, we're going to have buybacks, corporate share buybacks getting back in, and therefore bringing back an additional bid for markets. So, I just think it's a very balanced market. And, overall, again, we are getting back to the same type of logic, but from the Liberation Day, let's call it lows, the market was up what? The S&P was up 43, 44%. So, it's normal that after a huge run like this, you might take a few weeks, if not months, of market going sideways, which is not totally bad in and of itself, because it's just the market basically digesting new prices and showing acceptance at new higher levels. So, I wouldn't be, that worried for now. So, again, everything is always, as usual, dictated by structure, by technical analysis, and all the rest. But even if you want to check, before we move to the next layout, let's have a look at the Russell, which, it looks like this week it's the one. Is it suffering the most? Like, let's say from the high back to the lows, how much did it? Oh, wait a minute, what was it? It started in here and it kept on coming back down. So from the recent highs, it came down 5%. While instead, the Nasdaq, if you look at the previous weekly close, which was, I can't even remember that. So yeah, in here, Friday is down what? Marginally, not even 50 basis points, maybe. So maybe again we are looking at another rotation, this time out of small caps and back into the usual stuff, right? Could be, although again, if you look at a few single stocks, they don't look particularly good. And again, Nvidia is good enough. I mean, still going up, it looks like. But again, we were mentioning Microsoft, which, gave you that casual gap down of about what? Let's have a look on a daily time frame like this. Yeah. What? Well, nice. 8%. Not bad. And at a point throughout that day, it was down 12%. Not cool, right? Meta. Yeah, I mean, Meta opened up after earnings, came back down a little bit, but sure as hell, it's better than Microsoft. Tesla reported earnings. Nothing really. I mean, still here, still in this range. Again, you could throw the same type of range in here, right? Take this range, let's say, right? And then you see we deviate to the upside, we get back in. We deviate to the downside, we get back in. So it's not really going anywhere for now. But those were the three major earnings of this week. Next week, I think we're going to have, I should check. I think we're going to have Palantir. I think we're going to have Google at some point. This is this week. No. I thought, yeah, so wait. AMD, all right. Also Disney, right? Okay, but AMD, I think it's going to be important. I mean, for the tech sector, and then, and what? Lilly could be interesting for healthcare. And again, you've seen how much healthcare has been hit this week. What was that? I never remember. No, this is financials. Healthcare, was particularly down, although still in this range. But again, this might move that sector, right? Then Google, all right. Qualcomm. There you go, Qualcomm. I was thinking IBM too, but I'm not seeing it now. So maybe already reported. I can't remember. I'm not a religious follower of earnings, but nonetheless, sometimes I do follow the majors. But just these names: Disney, AMD, PayPal potentially, Lilly for the healthcare system, Pfizer if you're into the big pharma, and then Alphabet, Qualcomm. I think those would be the major movers for the markets next week. And of course, if you check the economic calendar, next week we're going to have ISM manufacturing PMI, services PMI, JOLTS, as said, and then, NFP and unemployment rate. So these will be the major market movers for next week. Quite a lot, to be honest. So, at the end of the day, for now, we are still in this massive cluster, even if you look at the moving averages, which are not really going anywhere. They're all kind of like, at least, if you discard the blue, which is really too short term, but if you look at the others, so 21, 55, 100 days, 200 days, they are all sloped to the upside pretty much. And the market is leaving kind of above all the majors, right? So the 55, the 100, 200, and all the rest. So, it's not a market which is crashing for now. Sure, it's not showing massive strength. And now that's a good access to get into what could be considered, to some degree, that sort of conspiracy theory, so to speak. But it is not really. Let's start out with these, right? And then we wrap up. Now, there was that theme about the rest of the markets outperforming what the US is doing for now. Although, nonetheless, it looks like European investors have a lot of, skin in the game when it comes down to US markets, especially equity markets. So, the thing about sell America, the rest of the world is selling, they are not buying our assets anymore. Well, I mean, maybe not. I mean, it's kind of controversial because you have reasons for both. So I've always thought, like, even if you check the recent projections, right? For 2026, the US is projected to grow at 2% when you look at GDP, right? The Eurozone, the Euro area, is projected to grow at 1%. So if the US will grow 2 times the rate of growth of Europe, why would you put your money into Europe or European stocks? Beside the obvious sectors like, rearm Europe, so therefore everyone is buying Raytheon and Leonardo here in Italy. Well, okay, I get it. But overall, right, why would you? I think, trying to look at both sides of the spectrum, I think one reason might be the dollar. Because when you check it out, it is true, the S&P might go up and up and up. Although, if let's take myself as a European, if I invest in the US stock market, yeah, sure, it's going up, but it is a dollar denominated asset. So let's say I wanted to cash out, I would need to sell the stocks, get the dollars, then swapping the dollars for euros. And when you adjust the S&P returns in euro terms, you see that it's not a lot, right? Because the market overall went up some 15%, but at the same time, if you remember, throughout 2025, the DXY came down a lot against the euro. So, in my local denomination, I'm not gaining a lot, right? So why would I? Especially, and again, I think I should have them on the chart right here, especially when you consider that there are things in Europe which are not performing badly. Like this is the DAX, so German benchmark, right? This is the FTSE, so British benchmark. This is the CAC 40, French. Not as good as the others, but, not bad. It resembles a little bit the S&P to some degree, right? This is the IBEX, so Spanish index. This is, need to change the time frame. The FTSE MIB, so Italian index. Then we got the Dutch index. And, markets that you wouldn't expect. Like, look at Greece, for instance. Or look at Poland. So again, there are markets which are going up in Europe, right? And when you add these components, for Europeans, it starts to be, maybe convenient to say, well, you know what, at the end of the day, these markets are going up as well. Some of them even better than the US. Plus, I don't have to, be bothered by the FX market, how do you call it? Exchange rate risk. So, you know what? I'm going to keep my money at home, right? That could be one thing, which contrasts the story and the narrative of much more growth in the US rather than Europe. Because at the end of the day, every single investor will try to make money. The problem, again, with money is that money are kind of, I know this is an exaggeration, but money are kind of different wherever you travel. And everyone will make his math in his current denomination. Sometimes it works in favor of the US, many times. Some other times it doesn't. And this might be one of those times where it doesn't, right? So just, to throw it out there, and then you could expand the topic if you wish and run to your own conclusions, right? But other than that, look, we were talking about buybacks coming back, right? So if you check, in green, they are pretty much, not saying all, but they play a huge role in price appreciation as for the broad market in the US. So, having them, it's not bad. And sure as hell, it provides a support for markets and, their ability to keep on going higher, right? So let's watch out for that before turning massively bearish, right? That doesn't mean, buybacks, first and foremost, they can always be suspended, It's not something that every single company is forced to do. They could say, you know what? We're not going to do it for now. So fuck it. So just bear in mind. What else? Well, this is basically what happens when you perform buybacks. And I think, quite honestly, one of the main reasons why buybacks are being performed, because you can boost the earnings, right? Think about it. You take the floating supply of shares, right, in the market. You buy back a good chunk of it. What you're going to have is less shares available on the open market. And therefore, earnings per share at that point should be boosted. It's just a simple ratio, right? If earnings per share are boosted, people are willing to pay more for the stock, aka stock goes up. So, that could be another component there. Would be much better if those excess profits would have been used to, R&D, new projects, new investments, new facilities, new research, new whatever, hiring more people. How about that, right? Instead, it looks like we are heading completely in the other direction, especially with AI. But, that's the controversy about buybacks, right? And, it looks like they're not going to stop or decrease relatively soon. So, expect them to keep on being a predominant force in markets. Now, let's try to move quickly now. This might be an ominous sign. So the majority, basically half, or almost half of global market, equity markets, basically printed new all-time highs all at the same time. It means over the last month. So, it's not just equity markets in the US. It's not just precious metals, right? Equity markets all across the globe are performing particularly good, which again, it goes back into the everything bubble. Everything is blowing up to the upside and all that. Yeah, it is fun up until it lasts, of course. But, when the correlation goes to one, right? Correlation in between stock and gold, or the stock market in one part of the world and the stock market in the other part of the world, when everything is going up at the same time, what's going to happen is that, everything is much more fragile because there is way less possibility of a rotation, right? So let's say, well, just for the sake of the example, well, the stock market in the US just pulled back 10, 15%. What am I going to do? I'm going to rotate my money in, I don't know, the European stock market. Well, but that's a whole time highs too. So, same logic, valuations, risk return assessment, downside risk. Well, okay, I'm going to put them in the Chinese stock market. Oh, well, it's ripping to the upside. So, that there is no way, there is no other place to hide, right? Or to be, again, quote unquote, diversified. Although, there is an asset class which has been particularly beaten up, didn't see a lot of appreciation, gives you a very few risk because the return on capital, it's basically, should I say the return of capital, it's basically guaranteed. US treasuries or whatever other treasuries. It might be European treasuries, might be, in China, they are buying Chinese treasuries too. So, I know Roman would have said Bitcoin because it's been out of favor. Maybe, but, as I laid out into the Bitcoin section, I don't fully subscribe to that narrative. At least for now. We'll see. I might be, call me a liar in a few months if it doesn't happen. Or, if it happens that, equity markets globally, they pull back and Bitcoin find a new moment to shine, right? Again, a little bit of a correlation in between the amount of buybacks and the S&P 4-week percentage change. You see that correlation there. It's pretty good correlation, right? And then what we got, margin debt, once again. So, margin is fantastic. When you take it out and when you increase it, so when you take out a loan, which is increasing margin debt, right? It's fantastic because it provides a lot of liquidity to keep on bidding up the markets. And, just bear in mind, it works in reverse too. And we've seen it in metals this week. So, it's good until it lasts again, right? Let's have a look at a little bit of seasonality for the month of February, which is not one of the strongest months, to be quite honest. So, average return, well, it should, historically, it should stay flat, right? More or less. Half of the times it's positive. The best performance, 7%, worst, 11% down. So, looks like the risk reward should be skewed to the downside in this case, right? As for the standard deviation, again, it's not one of the most volatile months. So, again, it would fit the narrative of this current two-tape market we are looking at. So it could be, right? Then what? A little bit of sentiment grasp. Looks like, AAII, that was what? American Association of, poor me. It's written right next to it. Individual investor, right? Okay, so looks like they're pretty bullish. These should be instead the money managers, so professionals, let's call it. And they are bullish too. So both the retailers and the professionals are bullish. All right. So at least we got the sentiment. Then what? Last thing, I think, people are talking about the shutdown. All right. Is it going to be a massive problem, the shutdown? I don't know for sure. Like, it depends on what you shut down, right? If you shut, and we've been there before, right? If you shut down a few national parks or whatever, fine, it's not going to be a huge deal, right? And I think I read that a lot of the budget expenditures were already been established, so they are not into question, I think. So, or my hunch is that it's not going to be a huge deal, especially for markets, because if you check historically, you see the shutdown rated by the longest to the shortest. But what you see is that, the 21 shutdown. Now, remember, these are data relative to prior to the latest shutdown that we had. But it looks like more often than not, they're not a huge deal, right? So, if the market, for whatever reason, would pull back and you start to hear your favorite YouTuber or Twitter influencer going like, well, it's because of the shutdown. No, it's not. No, it's not. There might be another reason if the market crashes 5-10%, but data says it's not going to be because of the shutdown, most likely, right? And to end up, just, I found it was kind of nice. I mean, if you want to take a screenshot of these, it doesn't have anything to do with what we are looking at recently, but for the long term, all the narratives going around right now, the basement trade in metals, the AI bubble, whatever, right? The world rejecting treasuries. This is just an example of what was going on in the S&P 500 throughout the recent years, right? And what type of narrative was kind of pushed throughout those times, and eventually, on a long enough time scale, how the market reacted to them, and how eventually they were sorted out. Just a reminder that sometimes, narrative is good up until a point people believe that, and when it gets faded, at that point it's not good anymore, and probably you realize that if you were betting on it, you're now on the wrong side of the trade, right? That being said, let's call it a day. I wish you all a very good rest of your weekend and a good start of the week. On Monday, bear in mind, probably it's going to start as it ended, a little bit of volatility. But, manage your risk tightly and don't lose your shirt in the process, right? That being said, as usual, be nice and be cool. We're going to talk again next week. Neil's out.
Mm-hmm. Mm-hmm. Mm-hmm.